Per usual, we're on the channel for educational purposes only and is not intended as financial advice. Micro Monday time, Cyber Monday as well. Starting with the usual institutional crypto flows from James at CoinShares, the largest flow into products since 2021, 346 million last week by their count, mostly coming into Bitcoin products, a little bit of Ethereum, a little bit of Solana, but definitely by far massive inflows into the Bitcoin product in Canada and in Germany, some in the US as well. And most of that was into the spot Bitcoin products. So look, the doomers, man, I can't take it any longer. But the doomers are trying to doom the spot ETF, saying there's not going to be any flows. A vehicle already exists in Canada. Not everybody has access to this stuff. Not everybody has access to GBTC and ETH in the United States. So look, we'll see. The proof is in the pudding, but we're seeing inflows already into similar products. And yeah, maybe it's a buy the rumor, sell the news. I don't think it will be. I think it'll be a volatile period initially. But let's open the product and see how the flows go. Then we can have that discussion and we can hold people accountable for saying that none of this actually matters when, surprise, it matters a lot. Okay, so yes, we're still seeing inflows fueled, as James says, by ETF. He doesn't say hopium, but anticipation. Bitcoin's still in that same range as yesterday for the past week, and Solana still looks just as dumpy and doomy to me as it did yesterday, and really it has looked for a couple weeks now. So on the crypto side, I certainly expect things to come down maybe a little bit more. TradingView, not a sponsor, but this is the last day to get the best discount of the year if you want an account at TradingView, should you so be interested. As far as the economic releases for this week, we have some home stuff I'll talk about. Tons of Fed speakers. There's like 25 Fed speaking appearances, some GDP stuff. PCE is probably the biggest thing of the week. And Jerome Powell, J-Dog, at the end of the week. Rates still pretty much holding at 5.25 to 5.5. Previously, this had been 100% with no hikes expected. And look, people don't realize it, but if we are not restrictive, inflation is not under control, unemployment is rising super slowly but fairly quiet, then yeah, keep hiking. Look, keep going, go for it. Depending on which data points you want to pull, which data points you want to look at, you're going to say the economy's great, or you're going to say the economy's horrible. You're going to say the consumer is tapped out. You're going to say the consumer's fine. I don't think there's any right or wrong answers there, honestly, because depending on which slice of consumer you're looking at, some are doing great, some are doing horrible. That's just the truth of the matter. The rich-poor divide is unquestionably growing. Market's still pricing in cuts, though, sometime early. Well, not early. We'll say mid next year, basically around Bitcoin halving. We'll see if that actually happens. Reverse repo, the inert pile of cash that's in ultra short-term overnight yield, is continuing to be drained slowly, moving into longer but also short-term yielding products on the shorter end of the curve. And yes, the government can fund itself in other ways outside of reverse repo, but this is the easiest low-hanging fruit that is getting shifted into shorter term yields. So it's going to be very interesting sometime around mid next year when this is fully drained. What happens to yields? Do bonds just go berserk, or just a nothing burger? But there's still a decent chunk of cash here, 865 billion, ready for more government debt, ready to absorb that. So another way to think about that, at least for me, is look, we've, without consequence in the United States, for the most part, have continued to issue debt. Yes, yields have gone way up. Yes, we've had a bear steepener, but it would be interesting to see what yields would have looked like without the reverse repo cash, without this buffer, effectively, to keep yields from going higher potentially. Yield curve still inverted. This just means that eventually we are likely to see a recession. But again, the recession comes with the uninversion. It comes much after the uninversion, in fact. So is unemployment still important? Sure. Is unemployment rising in 50 states? Based on what I can see and I'm told, yes. Eventually we will pay the piper. The price will be paid, but the yield curve is re-inverting, okay? So my question to the doomer folks is, look, you're just pointing out data and analyzing data. I get it, but what am I supposed to do from an investing perspective? Am I just supposed to sit out and be afraid and not participate in the market? That isn't necessarily a macro person's job to tell you how to trade or what they're trading, but this tells me be cautious, but participation is okay. Participation is okay. And people still love cash. They absolutely love it, and that makes sense. Yields on money markets are extremely high, and there's something like almost 6 trillion sitting in money markets based on recent numbers. If we think of this as some sort of baseline, around 4.75, let's say, so yeah, I would say there's about $1 trillion that has gone into money markets that you could probably consider dry powder. Now, it's probably there for an extended period of time, so long as rates remain high. But this is money that isn't in equities, isn't in crypto, isn't in gold, right? It isn't in anything else. It's in cash, in yielding instruments, basically in the short end. Quick check in with GDP, still fine. Again, look, we can say the data is fake and dumb. I get it, but I can't trade fake and dumb. I can trade what we think is going on. And so far, looks like things are okay. Trueflation holding sub 3 just barely. Sort of teasing a breakout here above 3 for the past couple weeks. Eventually, the CPI numbers will hit a local bottom, with Trueflation likely to continue to slowly tick up. That's the aggregate of what I'm seeing in the data estimations, mainly because of the housing component, which is super lagging. But if we look at the November CPI forecast, 3.07, so that's still down on a month-over-month basis. Still slightly higher than the current Trueflation print. So they're slowly converging here, but eventually CPI will hit a bottom, and eventually CPI should start to creep up slowly. And the question I have is, how are markets going to react to that? Because it's pretty much been down only on CPI for many months now. And the markets have absolutely loved that, basically equating that to the Fed is done hiking. Something that's really helped inflation is oil has just dropped off a cliff, right? OPEC's in a panic again. They want to cut production again. They delayed the meeting. It's their job to kind of stabilize prices, right? So it makes sense that they are back at the table looking to cut again. But oil sub 80 is where we want to be on the inflation side of things. Speaking of inflation, in my mind, how do we say and tell people that some people are fine, some people aren't, when we're all experiencing our lived experience of everything's higher, right? This is a Bloomberg article talking about January 2023 to October. Everything is up. So we're eating like a decade's worth of price increases in 3 years. So yes, everyone is very angry, including myself. Okay. Nobody wants to pay 20% plus on most of these prices for no reason, right? You could say supply, you could say greedflation, you could say whatever you want, but it's not like, curtains got 20% better over the past 3 years. And normally the inflation happens and we don't necessarily know it happens. In a medical term of that, it would be like an insidious, slow creep of inflation, right? 2%, 3%, whatever it is. So we're front loading all of that. And of course people are pissed, okay? People are definitely upset. And ultimately on the political landscape, this might be why, it will certainly help why Biden doesn't get reelected, potentially, right? Again, I don't care for either of the candidates, but increasingly you're going to see the political right in the United States blaming the political left for these problems. And we're certainly seeing the doomers out in full force on that stuff. One thing that has gone up a lot is also sporting events, just another random anecdotal data point, as people are maybe focusing on experiences over stuff, and that certainly helps drive those numbers higher. Bianco had an interesting thread about consumer sentiment. So the UMich consumer sentiment numbers have been continuously low here. And what's interesting is if you separate that out between red and blue, even looking at the Trump period, your consumer confidence as measured by the survey is basically just your political position, right? So the Republicans are pissed. Democrats say we're mostly fine. What's interesting, I've started to use Threads more and more, the Instagram Twitter clone, and there is much more doomerism on the Twitter algorithm. It's dialed up to like 55 relative to Threads, which is probably more, left leaning. So definitely encourage everyone to get out of their own bubble and look around a little bit. have your own viewpoint, but be open-minded a little bit. This is the TSA passenger numbers, okay? So my question is, if the economy is so bad, so awful, are we ready to experience an all-time high in TSA, basically US travel? 2.9 million, all-time high. Yes, it's a holiday. Yes, it's one data point. I get it, but people are traveling, and it's just wild to me that this is what yesterday looked like. No accidents, no crashes. Beautiful thing, air travel. And kind of semi-related, this has been cropping up more and more over the past week, this idea of a Northeast Corridor concept for high-speed rail. This is likely never going to happen, but would be absolutely amazing as somebody who's lived in the East Coast and enjoyed Amtrak for many years. When I initially saw this, Chicago was left out, and in the last version of the concept, they do connect Chicago to the corridor. And someone who would obviously hate this would be the airline industry, because it would just kill a lot of passenger traffic there. But a bit self-serving for me as somebody who's from Michigan and lived on the East Coast. Anyway, very cool idea. We'll see if it ever happens in our lifetime. Certainly a demand for something like that on this side of the country. Going back to the consumer, again, this is Goldman saying the consumer is okay. So look, in aggregate, as the commenters are saying here, yes, if we average everything out, people are doing great. Now, I realize that's not reality for most people, but it's certainly hard to ignore a data point that looks like that, and we can measure it all sorts of different ways using all sorts of metrics. I think the thing is, if you hear or see a data point that says everybody's fine and you're not, you're even more upset. Or if you see or hear a data point where a certain segment of the population is doing fine and you're not, you're even more upset, which is understandable. But in aggregate, we're doing okay. Not saying we can't have a recession next year, but we're doing okay. This is savings across several different income thresholds, and obviously the people at the top have done the best. That's the least shocking data point of this video since 2020. But across the board, savings has risen. Now, looking at those inflation numbers and contrasting with this, right? If inflation is up on average 20 to 25%, and your savings is not up that amount, or your wages are not up that amount, again, you're going to be upset. You're going to be continuously squeezed. How are you going to catch up? It's going to be increasingly hard to catch up with those rises in inflation. And another data point, I love the car dealership guy, not because of the stuff he puts out, but it's just, random data points from another segment of the consumer. Used auto loan rates, 14.35%. Absolutely wild. Again, who does this hurt most? The people who can't afford a new car or have bad credit or are at the lower end of the spectrum, right? They're going to continually get left behind with rates this high. And then if we talk about Black Friday, I don't know why, but Black Friday just has a special place in my heart. You can look at any variety of news on Black Friday data. You have people focusing on, the record numbers. You have other people focusing on the buy now, pay later stuff, which I think I have down here. So you will see what you want to see. This is a Rorschach test. You can say, well, no one has any money. They want to keep spending. They're using buy now, pay later. It's over. The economy's over. Everything's done. This is going to blow up. Or you can just look at the numbers and say, wow, And then you've got similar stories pointing out that nobody was at the stores on Black Friday. Gee, why would that be? Why aren't anybody at the stores? Do you want to go to a store at 3 a.m. when you can just buy it online a week prior? There's certainly more deals online. The deals are much different than they used to be in that it was literally that day up until the afternoon. They've extended that over the years into Thanksgiving, into the week of Thanksgiving, into the weekend after Thanksgiving, into Cyber Monday, right? So there's less of a reason, less of a need to actually show up at the store. Could this also be the consumer is tapped out? Sure. But you can't just assume the consumer is done if they're not showing up physically at a store. I mean, come on, guys. And then, of course, you have data points like this, where 60% of adults are living paycheck to paycheck. So you can find the data points for either side of that argument. They're all out there right now. So just be careful batting for one team or the other. This is another not so great, not so hot data point with credit card charge-offs, delinquencies rising. I think this might be an all-time high. 2008's not on here, but look, there's plenty of bad data out there. Plenty. But what is enough to actually tip over the apple cart and destroy this consumer-driven economy? I don't know. We'll see. Some housing stuff. Housing keeps coming down, which as a non-homeowner is fine. Even as a homeowner, what do you care at the end of the day? Look, you're in that home for probably years. It's illiquid. I realize people benchmark their net worth at an all-time high and assume they're just, miserable if prices go down. But I think we all need to collectively acknowledge the rate of change pre-pandemic is probably where we're headed back to as far as housing prices. And this is eventually, of course, going to feed its way through CPI, which is continuing to come down. We had the largest drop in median sales prices in quite some time in October. And again, if you want to read into that and say, look, this means a recession's coming next month, go for it. But I would say, we're returning to the mean. Yeah. Housing prices are insane. Mortgage rates are insane. Who's buying a house right now, realistically? Prices have to come down if rates are staying this high. And we have seen a drop in new home sales much lower than expected, which to me makes perfect sense based on prices and rates. I don't think this is anything crazy or to be worried about, but maybe I'm just too much of an optimist. I don't know. And here's that inflation data again. The rent versus CPI rent. CPI rent is still working its way through the equation, whereas new rent is basically back to pre-pandemic levels already and continuing to come back down. So this will certainly help CPI come down, and it will help the Fed likely hold the rates where they are, right? And this data is through September 2023, but we have been seeing a rise in multifamily housing delinquencies. So to me, data is all over the place. I don't think everything is doomerish as I'm seeing it. Maybe I'm just on Twitter too much. I don't know. As far as the S&P and charts are concerned, we're getting a daily bullish cross on the cloud, which at this point is, not a shocker considering the slingshot from 4,100. You've got a lot of people still in disbelief up here saying this doesn't make sense, right? The doomer creep in my head is just, it's getting louder and louder because I'm looking at charts like this and saying, look, what am I supposed to do? Am I supposed to just sit out everything? I guess that's the objective here. I don't know. Looking at the TKC clamp, or just, we're just way overbought on the S&P. There's no doubt about it. There's no clear RSI bear div yet. Would I like a retrace? I would love a retrace. I don't know if I'll get it, but we're definitely overbought on the cloud. RSI says we're fine. Candle structure, I don't think there's anything super interesting to read into there. Doesn't look mega bullish, but doesn't look bearish. And then if we look at seasonality, right, we got the Santa rally coming up, and it's literally just up and to the right based on seasonality. So we'll see if we actually get a pullback, if seasonality lets us get a pullback. I'm rooting for that. I hope the bears can get trapped again for the 53rd time this year. And this was a great chart somebody put together talking about there's always a reason to sell. There's always bad news. There's always things going on somewhere. But over the long term, it has been up and to the right for the S&P since the 80s, mainly because we keep printing money and devaluing the dollar. And, we can argue about that. But staying out of the market for an extended period of time certainly has hurt you over time historically. Qs also have a daily Kumo twist, no bear div on RSI, still overbought based on cloud parameters. Would also like a pullback here, maybe to these gaps that are currently in price. We'll see. We'll see if we get it. Both still look like the S&P and the NASDAQ still look like they're fine setup for a cup and handle. We can argue about how we want to measure this, but at the end of the day, everybody sees this. Everybody's looking at this. I'm not saying it will happen. I'm just saying it's hard to be bearish when you have a pretty blatant multi-year chart pattern on your hands here. And it doesn't have to make sense. We can have all the doomer data. All the data points can be doomer. But look, this is why I focus on technicals. And if we get a full-blown breakout on this puppy, send it. Absolutely send it. NASDAQ as well also has that Santa rally seasonality. This is just comparing 1999 to 2023. But man, that would be absolutely wild if the NASDAQ just kept going. And even though Bitcoin's not really coupled with or correlated with equities as much anymore, I can't imagine Bitcoin would sit out if NASDAQ and the S&P are at all-time highs again at the end of the year. Of the Mag 7, Amazon still looks the best to me. It's been up, 4, 5, 6 weeks in a row now, but I still like this as a chart pattern. And kind of held at its 2021 levels. It didn't have some mega bubble. It pulled back with the rest of tech. So I do like all-time highs for Amazon. by Q2 next year at the latest. This looks really good. As far as banks, real quick, there are some problems in the banking sector still. This is something I agree with the doomers on. BTFP is rising again. This is the lending program where the banks can send their treasuries and exchange them at par. And rises in this does point at potential problems in the banking sector. There is another slow-moving, Evergrande type issue in China, potentially not commercial real estate or real estate related, but a shadow bank that is quite large and looks to be exploding here. And as the article says, they lent billions to property development. So China's still in a lot of trouble from a real estate and banking vantage point, and that may have contagion with our own commercial real estate market in the United States. Looking at the KRE ETF, this chart actually doesn't look horrible. I wouldn't want to touch this based on fundamentals, but a W double bottom is possible here, and ascending triangle is possible here. Obviously, if this thing goes back to sub 40, that would be very problematic. But I'm not quite seeing stress in regional banks based on the KRE ETF. Lastly, I'll just talk about ARK again, because ARK holds a lot of coin. Coin's doing extremely well today again. And ARK is set up potentially for this wild edge-to-edge move on the cloud. And if this does play out, that would likely mean NASDAQ to all-time high plus. So overall, things still look pretty good. Things still look pretty good on the legacy side. Sorry for this one. Like, dislike, comment, share, subscribe, and happy trading.